All right, let's get right into it. Every single successful business, whether it's a tiny startup or a global giant, runs on one thing: money. But here's the thing. It's not just about having money. It's about how you manage it. Financial management is really the lifeblood of a company. It's the engine that can turn a great idea into a powerful, lasting business. So, how does it all actually work? Let's find out.
To really get our heads around this, we're basically going to follow the money. First, we'll tackle the big question: what is a company's ultimate financial goal? Then, we'll crack open the toolkit they use to raise all that cash. After that, we'll take a trip to the marketplace where all the action happens. And finally, we'll meet the referee who makes sure everyone is playing by the rules.
Okay, so let's start with the big one, the most fundamental question of all. When a company is managing all its finances, what is it really trying to do? What's the end game here?
And this brings us to a classic, and I mean classic debate in finance. Is the main goal just to maximize profits? Get as much cash in the door as possible right now. Or is it something bigger, something more long-term, like maximizing wealth for the owners, the shareholders?
Okay, let's put these two head-to-head. Profit maximization. It sounds pretty straightforward, right? Just chase the biggest number. But here's the catch. It's a seriously flawed strategy. It's totally short-sighted. It doesn't care if a dollar today is worth more than a dollar 10 years from now, and it completely ignores risk. Wealth maximization, on the other hand, is a much smarter play. It's all about increasing the company's share price over the long haul. And that forces you to think about both the risks you're taking and that crucial idea that money in your hand today is way more valuable than money you might get tomorrow.
So, this is why modern finance is all in on wealth maximization. The secret weapon here is something called net present value. The easiest way to think of it is like this. It's a financial calculation that tells you what all the future money a project is expected to make is worth in today's money. If that value is more than what it costs to get started, you've got a winner. It's just a much clearer, more sustainable way to build a really powerful company.
So, if the mission is to maximize wealth, a company needs fuel for its engine, right? It needs capital. But where does that money come from? Well, it's time to pop open the Financial Manager's Toolkit and check out the instruments they use to raise that all-important cash. First up, we've got the most fundamental tool in the entire kit: the share. Now, this is super important. It's not a loan. When you buy a share, you are literally buying a tiny slice of the company pie. That's why we call it ownership capital. For the company, it's a way to get money without going into debt, and for an investor, it's a shot at sharing in the company's future success.
But listen, not all shares are created equal. They usually come in two main flavors. Equity shares are what you probably think of as classic stock. They give you voting rights and a shot at huge growth, but they also put you at the very back of the line if the company goes belly up. Preference shares are kind of the safer bet. You get a fixed payout and you get your money back before the equity folks, but the trade-off is you usually don't get a say in how the company is run.
But what if a company is thinking, I need cash, but I don't want to give away any more ownership? Well, that's where debentures come in. Honestly, you can just think of a debenture as a very formal IOU. An investor lends the company money, and in return, the company promises to pay it back with regular, fixed interest payments. It's how you raise capital through debt, not ownership.
And of course, these IOUs come in different varieties too. You can pretty much classify them by asking three simple questions. First, can you eventually convert it into shares? Second, is it secured, meaning is it backed by the company's actual stuff if things go wrong? And third, is it redeemable? Is there a hard deadline for when you get your money back? This kind of flexibility lets companies tailor their borrowing to exactly what they need.
And the toolkit doesn't stop there. You've got some really specialized gear too. There's venture capital, which is like rocket fuel for exciting new startups that have huge potential. And then there's lease financing, a super practical move that lets a company use expensive equipment like machinery or vehicles without having to pay a fortune to buy it all up front.
Okay, so we've got our goal, wealth maximization, and we've got our toolkit with things like shares and debentures. Now for the big question: where do companies actually go to use these tools? It's time to step into the financial arena, the marketplace where all this trading happens.
First up, the primary market. And honestly, the best way to think about this is like a brand new car dealership. It's the one and only place where a company creates and sells its shares for the very first time, like in an IPO. The most crucial part to remember here is that the money goes directly from the investor's pocket into the company's bank account to fund its growth.
So what happens after that initial sale? Well, those brand new shares and debentures move into the secondary market. This is the used car market. It's the stock market you see on the news every day. Here, investors are just trading amongst themselves. And while the company doesn't get any new cash from these trades, this market is absolutely vital. It provides liquidity, which is just a fancy way of saying investors know they can sell their shares easily. And without that, nobody would ever buy in the primary market in the first place.
So let's just nail this down one more time. Primary market, the company sells to you, the investor, to raise fresh cash, usually at a fixed price. Secondary market, you, the investor, sell to another investor, trading existing shares at prices that go up and down all day long. You absolutely need both for the whole system to work.
Now, when you've got a giant arena with billions of dollars changing hands every single day, you can't just let it be a free-for-all, right? You absolutely need some rules. You need a referee to make sure the game is fair for everyone. And that brings us to our final piece of the puzzle.
You know, every major market in the world has one of these referees. In the United States, you hear about the SEC all the time. Well, here in India, that role is played by the Securities and Exchange Board of India, or CBII. Their mission is always the same: keep the market in order, protect investors like you and me, and make sure everything is fair.
You can really think of SEBI as wearing 3 different hats. First, they wear the protector hat, fighting against fraud and any shady business to make sure investors don't get taken for a ride. Then there's the developer hat, where they're always trying to improve the market and make it more modern and efficient. And finally, they wear the regulator hat, setting all the rules of the game for the stock exchanges, the brokers, basically everyone who operates in the arena.
And just like that, we've come full circle. We've gone from a company's core goal to its toolkit, to the marketplace, and finally, to the referee. So with all this in mind, I'm going to throw that first question right back at you. When you look at the companies you buy from every day, what do you think they're playing for? The short game for a quick profit, or the long game for lasting wealth? The answer tells you a whole lot about where they're headed.